Imagine a scenario where the United States government dramatically increases its issuance of Treasury bonds, flooding the market with government debt to finance growing expenditures. This would significantly expand the money supply in the economy, triggering a chain of complex economic reactions. The question is, what happens if the US drastically ramps up issuing Treasury securities, and how would that impact everything from inflation and interest rates to the global economy and everyday Americans? This topic is not just theoretical. Since the 2008 financial crisis, the US has steadily expanded its national debt to fund stimulus packages, social programs, and emergency relief efforts. The COVID-19 pandemic saw unprecedented levels of bond issuance as the government poured trillions into the economy to stave off collapse. But what if this trend accelerated even further? What if policymakers decide to massively increase bond issuance without raising taxes or cutting spending? To understand the consequences, we need to explore the mechanics of how issuing more Treasury bonds affects the money supply, how this influences inflation, interest rates, the value of the dollar, financial markets, government finances, and global geopolitics. We also need to look at potential unintended consequences, including the risk to financial stability and inequality. The U.S. Treasury issues bonds to borrow money to cover the federal budget deficit when government spending exceeds revenue. These bonds are sold in public auctions and bought by a wide array of investors, including domestic banks, pension funds, foreign governments, and the Federal Reserve itself. The Treasury promises to repay these debts with interest over periods ranging from a few months to 30 years. When the Treasury issues more bonds, it increases the supply of government debt in the financial markets. In a typical functioning market, this additional supply would put downward pressure on bond prices and push yields, interest rates, higher because investors demand greater compensation for increased risk or supply. However, multiple factors influence the actual interest rate movements, including monetary policy, investor demand, and global economic conditions. One key factor that ties bond issuance to the money supply is the role of the Federal Reserve. The Fed can buy these bonds on the open market, a process known as quantitative easing, QE, effectively creating money electronically to pay for the bonds. This increases bank reserves and the overall monetary base, thereby expanding the money supply. If the Fed aggressively buys government bonds, it effectively monetizes the debt, increasing money circulating in the economy. If the US government significantly increases bond issuance, and the Fed buys much of that debt, it will pump a large amount of money into the financial system. More money chasing goods and services can lead to inflation if the economy's productive capacity cannot keep pace with increased demand. But there are other pathways through which bond issuance impacts the economy. Financial institutions use Treasury bonds as collateral to borrow money and leverage other investments. Treasuries are considered risk-free assets, and their availability affects credit creation in the banking system. A flood of bonds can either improve liquidity or, if yields rise sharply, cause mark-to-market losses on banks' holdings, risking financial instability. Let's examine what happens first to interest rates. Theoretically, increased supply of bonds should raise interest rates, because the government competes with other borrowers for funds. Higher interest rates can crowd out private investment, as businesses face more expensive borrowing costs. But if global investors and the Fed buy up bonds, rates may stay low despite the surge in issuance. The post-2008 world showed us that central banks can keep long-term rates depressed even as debt rises. However, low rates may not persist indefinitely. Should investors lose faith in the government's fiscal discipline or expect rising inflation, bond yields could rise sharply, increasing the government's interest costs and feeding a vicious cycle of borrowing more to pay interest. This dynamic is sometimes called a debt spiral. Inflation is arguably the most direct and worrying potential consequence of vastly increasing the money supply through bond issuance. Inflation occurs when aggregate demand outpaces supply, causing prices to rise. By flooding the system with money, the government can push demand up, especially if spending targets consumers and infrastructure projects. But if the economy is operating near full capacity, this can trigger broad price increases, eroding purchasing power. On the other hand, inflation depends not just on money supply, but also on the velocity of money, how fast money circulates in the economy. For much of the last decade, velocity has been low. Banks held large reserves without lending aggressively, and consumers saved more. If velocity stays low, inflation may remain subdued despite increased money supply. But if velocity picks up as confidence returns or due to policy changes, inflation could surge rapidly. The Federal Reserve plays a critical role in anchoring inflation expectations. If the Fed can convince markets and the public that inflation will remain under control, wage and price demands stay moderate, avoiding a wage price spiral. However, large-scale bond issuance challenges the Fed's credibility. If it is seen as monetizing deficits, blurring lines between fiscal and monetary policy, this could undermine the Fed's independence and inflation-targeting credibility. Another consequence to consider is the impact on the U.S. dollar's value. The U.S. dollar remains the world's primary reserve currency, supported by the size of the U.S. economy, political stability, and liquidity of its financial markets, especially treasuries. If bond issuance leads to perceptions of fiscal irresponsibility, the dollar could weaken against other currencies as investors diversify holdings. A weaker dollar would make imports more expensive, feeding inflation, but also boost exports by making American goods cheaper abroad. However, a rapid or disorderly dollar depreciation could unsettle global financial markets because many countries and companies borrow in dollars. Dollar weakness might prompt capital flight and increase the cost of servicing dollar debts worldwide, risking financial contagion. Equity markets often respond to changes in interest rates and inflation expectations. Lower interest rates generally support higher stock prices by reducing the discount rate applied to future corporate earnings and encouraging investment in riskier assets. A large increase in bond issuance funded by the Fed's purchases can initially boost stocks and real estate as liquidity floods the markets. However, if rising yields signal inflationary pressures or fiscal risk, equity valuations may suffer. Higher borrowing costs hurt corporate profits, especially in capital-intensive sectors. Inflation also erodes consumer spending power, which can weigh on sales and earnings. Stock market volatility tends to increase during periods of fiscal uncertainty. The banking sector is intricately linked to Treasury bond markets. Banks hold large portfolios of treasuries as liquid, low-risk assets, and use them as collateral to borrow in short-term funding markets. An oversupply of treasuries can improve liquidity in normal times, but rising bond yields reduce the market value of bonds held, potentially causing unrealized losses. If these losses become large, they can impair bank capital and threaten solvency, especially if combined with withdrawals of deposits. A banking crisis triggered by bond market turmoil could exacerbate economic instability, forcing regulators to intervene with emergency lending or bailouts. Thus, increased bond issuance raises systemic financial risks if not carefully managed. Another area affected by expanded bond issuance is wealth inequality. Monetary expansion tends to boost asset prices faster than wages, disproportionately benefiting wealthier individuals who hold stocks, bonds, and real estate. This can exacerbate existing inequalities. If bond-financed government spending targets direct cash transfers or social programs, it might help lower income groups. But often, monetary stimulus feeds financial markets, widening the wealth gap. The interplay between fiscal priorities and monetary policy will determine the social consequences of increased bond issuance. Government finances themselves face a paradox. On the one hand, issuing more bonds finances spending without raising taxes immediately. On the other hand, increasing debt means higher future interest payments, which may necessitate tax hikes, spending cuts, or more borrowing in the future. Pension funds and retirement systems rely heavily on Treasury bonds for safety and predictable returns. Rising yields can reduce the present value of liabilities, but also reduce bond prices held in portfolios. Managing these shifts is a challenge for pension fund managers and policymakers. The international implications of a surge in U.S. Treasury bond issuance are profound. Foreign governments, especially China, Japan, and oil-exporting countries, are among the largest holders of U.S. debt. Their continued willingness to buy Treasury bonds helps finance deficits and underpins dollar dominance. If these countries become wary of expanding U.S. debt or fear dollar depreciation, they might reduce purchases or diversify reserves into other currencies or assets. This could force the U.S. to offer higher yields to attract buyers, raising borrowing costs. It might also accelerate efforts to create alternatives to the dollar-based financial system, reshaping global economic power. Political dynamics within the United States could become highly polarized. Some factions emphasize fiscal responsibility and warn of hyperinflation or debt crises, while others prioritize social spending and argue that borrowing at low interest rates is sustainable. This ideological clash complicates policymaking and increases economic uncertainty. A growing national debt could become a major campaign issue, with debates about intergenerational fairness and economic priorities intensifying. Political gridlock might even threaten government funding or lead to credit rating downgrades, further raising borrowing costs. To manage the risks of increased bond issuance, policymakers have several potential tools. They could raise taxes, cut spending, or reform entitlement programs to reduce future deficits. The Federal Reserve might implement yield curve control, capping bond yields by committing to unlimited bond purchases at set prices to keep borrowing costs down. Innovation in monetary policy, such as introducing a central bank digital currency, might allow more direct control over money flows and spending, potentially reducing the need for massive bond issuance. Structural reforms to improve productivity and growth would also help balance budgets over time. Historically, the United States has faced periods of high debt relative to GDP, such as after World War II. In that era, sustained economic growth and moderate inflation gradually reduced the debt burden. However, the post-war environment was different, with rapid productivity growth and a global dollar system supported by U.S. manufacturing strength. In contrast, the 1970s showed the dangers of unchecked inflation, with double-digit rates and stagnant growth hurting living standards. Japan's experience with very high debt and low interest rates over decades offers mixed lessons, including the risks of slow growth and deflationary pressures. For individual Americans, a surge in bond issuance and its macroeconomic consequences could mean changes in borrowing costs, inflation rates, and investment returns. Households would need to be financially savvy, diversifying investments, managing debt carefully, and understanding inflation's impact on savings. Consumers might face higher prices for goods and services if inflation accelerates, squeezing disposable income. Conversely, increased government spending on social programs or infrastructure could improve living standards and employment opportunities. Ultimately, dramatically increasing the money supply by issuing more Treasury bonds is a double-edged sword. It can provide resources for urgent needs, stimulate growth, and help manage crises. But it also risks inflation, higher interest costs, financial instability, wealth inequality, and geopolitical uncertainty. The outcome depends heavily on the size and pace of bond issuance, investor confidence, monetary policy responses, and the broader economic environment. Transparency, credible fiscal frameworks, and coordinated policy actions are essential to mitigate risks. For policymakers, walking the fine line between necessary spending and fiscal prudence is a challenge that will shape America's economic future for decades. For citizens and investors, understanding these dynamics is crucial for navigating uncertain times. As the United States contemplates the path ahead, the world watches closely. The choices made today about debt, money supply, and economic strategy will ripple through global markets, governments, and households for generations. That concludes the detailed exploration of what might happen if the United States dramatically increases its money supply by issuing more Treasury bonds. If you found this comprehensive dive helpful, please like, share, and subscribe for more deep analyses of important economic questions. Thank you for watching.